For the last 80 years, the United States has had a superpower that has nothing to do with its military, its technology, or its GDP. It's a financial superpower so quietly dominant that most Americans have never heard of it, and most people who have can't explain it. It's called the exorbitant privilege. And it works like this. Because the entire world needs US dollars to buy oil, settle trades, and store wealth. The US gets to borrow money at artificially cheap rates while running deficits that would have destroyed any other country decades ago. It's essentially a global tax that the rest of the world pays to America just for existing. And for 80 years, everyone played along because they had no choice. Until now. Because right now, for the first time since that privilege was granted after World War II, the world is starting to quietly take it back. And the speed of what's happening should be making a lot more noise than it is. Let's start with the number that should be on the front page of every financial publication. Foreign central banks just sold over $90 billion in US Treasuries in 5 weeks. 5 weeks. Holdings of US Treasuries at the New York Federal Reserve, where foreign central banks park their US bonds, have fallen to around $2.7 trillion, the lowest level since 2012. And this isn't the slow gradual diversification story that analysts have been telling for years. This is a pace of selling that the market has not seen in a very long time. And the story behind the selling gets more interesting the deeper you go. Because it's not just one country, it's oil-importing nations like Turkey, India, and Thailand, who are being forced to sell treasuries to defend their currencies because oil is now above $100 a barrel and they're paying for surging energy imports priced in dollars they don't have. That's the war in the Middle East creating a forced liquidation of US government debt in real time. Let that sink in for a second. A geopolitical conflict halfway around the world is directly causing foreign governments to dump the bonds that fund the United States of America. And that's just the short-term pressure. The longer-term picture is even more unsettling. The US dollar fell about 11% in the first half of 2025. That's the biggest single-year decline since 1973. Not a recession year, not a financial crisis year. 1973 is most famous for the Arab oil embargo and the start of the Nifty 50 collapse. And Morgan Stanley's research estimates the dollar could lose another 10% on top of that by the end of 2026. Through 2025, the dollar dropped 13.5% against the euro and 13.9% against the Swiss franc. These aren't currencies of powerhouse economies eating America's lunch. These are currencies of countries that are supposed to be economically weaker than the United States. The dollar losing ground to the Swiss franc by almost 14% in 1 year is the financial equivalent of showing up to a race in a Ferrari and losing to a Volvo station wagon. Something structural is happening. Here's what it actually means. The US dollar, being the world's reserve currency, isn't just a bragging right. It's a mechanism. When the dollar is strong and trusted, US Treasury bonds are the world's safest asset, which means everyone wants to own them. Which means the US can issue as much debt as it wants at relatively low interest rates because demand is always there. Which means the government can run $2 trillion deficits without the bond market panicking. Which means mortgage rates stay lower than they would otherwise be. Which means corporate borrowing is cheaper. Which means the whole US economy gets a permanent structural subsidy that it has never had to pay for. That's the exorbitant privilege. And it's not abstract. Every American household with a mortgage, a 401k, or a credit card is a direct beneficiary of this mechanism functioning quietly in the background. Now start unwinding it, and all of those things get more expensive at the same time. Because here's how the math gets ugly fast. About 24% of the $38 trillion US national debt is owned by foreign governments. Japan alone holds over $1 trillion, China holds hundreds of billions. Europe collectively controls somewhere around $2.5 trillion. If those holders start demanding higher yields to compensate for dollar depreciation risk and political uncertainty, the cost of servicing US debt explodes. According to J.P. Morgan's research, each single percentage point decline in foreign holdings relative to GDP, roughly $300 billion in treasuries, pushes long-term yields up by more than 33 basis points, and higher long-term yields ripple through everything. Mortgage rates follow the 10-year treasury. If 10-year yields climb to 6.5% or 7%, mortgages follow. And at 10% mortgage rates, home values don't gently correct, they collapse. And the middle-class wealth that lives in home equity goes with them. And this is where the historical parallel nobody wants to say out loud comes in, because this exact story happened before, just not to America. After World War I, the British pound was the world's reserve currency. Britain had the empire. Britain had the navy. Britain had the financial infrastructure. And then the United States emerged bigger, stronger, and with more gold. And over the course of 30 years, slowly, then suddenly, the pound lost its reserve status. Britain went from being the country that set global interest rates to being the country that had to beg the International Monetary Fund for a bailout in 1976. The transition wasn't a single event. It was a gradual erosion of confidence in British fiscal management, followed by a series of crises that each chipped away at the pound's credibility, until one day the world just stopped treating it as the anchor currency. And here's the thing, at every stage of that decline, British officials insisted it was temporary. It was just a cyclical adjustment. The fundamentals were solid. Sound familiar? And yet, and this is the uncomfortable part, the argument for why it's different this time is actually not crazy, because the dollar has been declared dead more times than any currency in history, and it keeps surviving. The dollar's share of global foreign exchange reserves has been declining for 2 decades, and it still sits at 58%. There is no clean alternative. The euro is a political minefield. The yuan is not freely convertible. The yen can barely handle Japan's own debt load. And the countries moving away from the dollar the fastest, Russia, China, Iran, are doing so partly out of political necessity rather than because they have somewhere better to go. Gold is hitting nearly $5,000 an ounce, which tells you something about how much trust in paper currencies is fading. But gold doesn't pay interest, and it can't settle a trade in Shanghai. So yes, the dollar could lose 20% of its value in 2 years, while still being the world's reserve currency. These two things are not mutually exclusive. A divorced couple can still live in the same house. It's just deeply unpleasant for everyone. Which brings us to the uncomfortable truth. The real danger isn't a sudden collapse. It's the slow erosion that tightens financial conditions for everyone who doesn't notice it happening. If foreign central banks continue to reduce their treasury holdings, if the dollar continues its decline, if the term premium on long-dated US bonds continues to rise, then the cost of everything the US government does gets more expensive. At $38 trillion in debt and a $2 trillion annual deficit, a 1% rise in average borrowing costs adds $380 billion a year to the interest bill. The US already spends more on interest payments than on defense. If that number keeps climbing, it crowds out every other government priority. And that feedback loop, more debt, higher rates, more interest, more debt, is the thing that has ended every prior reserve currency. Not a sudden crash, a slow squeeze that makes the math impossible. And right now, all the forces that cause that squeeze are moving in the wrong direction at the same time. So here's what I want to know. Do you think the dollar's decline is just a normal cycle and it recovers from here? Or do you think we're watching the early stages of something more structural that plays out over the next decade? Drop your answer in the comments, because this is one of those slow-moving stories that nobody takes seriously until it's already happened.